tell us all about what do you anticipate happening in the economy.
Well, thank you. I assume everyone can hear me well and see the presentation on the computer, right? Right.
Yes, yes,
Okay,
absolutely.
very good. So, in the interest of time, fortunately, Marty, my presentation is short and sweet today. So maybe we can catch up a little bit sooner than this afternoon. But generally, as usual, right, economic updates and forecasts usually start with the U.S. economy. And I'd like to talk some about policies, the fact that we have both fiscal and monetary policies working in nearly opposite directions for us, which is one of the reasons why things are so complicated for the Fed and for interest rates. Last time when I visited this group, there was interest in learning more, not just about the domestic economy, but about the international, what's going on in Europe and what's going on in Japan. And because we really do, like it or not, we live in a global economy. And then interspersed, right, is this idea that we'll be talking about what the growth prospects are for each of these regions. Every academic economist has to do this, right? We have to show the components to GDP because, quite honestly, we can talk about GDP, but what goes on within that stat's important, right? So on the left-hand side of the chart here, you can see that's total GDP quarter by quarter average for the last year plus. And then the components, right? So you've got consumption and investment and government spending and net trade or net exports. But we just have to really marvel at the United States economy right now, right? It ended up in 2023, despite the fact that interest rates, short-term Fed funds interest rates, remember, most economists like to differentiate between interest rates and short-term and long-term interest rates for obvious reasons. But despite that, we've had, last year we had over 3% growth rate, and that was larger than the year earlier. So we continue to defy, our growth rate continues to defy expectations. And every element of our growth, personal consumption expenditures, as you can see on the chart, private domestic investments, while barely, government spending and foreign trade added to growth last year. And we'll just see what happens this year, right? But one of the key reasons for this consistently robust growth is the generous pandemic stimulus, right? Or the generous government stimulus or fiscal policy, right? And last year it was 26% of GDP. That's a very big number. And that's more than double any of the other rich world averages. And this definitely fueled inflation, right? But in fueling inflation, it also ensured fast growth, okay? And if you look at this graph, should it continue or should the interest rates not cause too much of a slowdown, we could see consumption exceeding 70% of the GDP stat. So as the COVID crisis passed, the government continued to borrow away, and there's no real evidence that they're not going to continue to do this. The underlying deficit is over the past year was nearly 8% of GDP, and that supported the demand that we need for this growing economy. Another reason for the consistent, robust growth is this incredible growth in productivity. Oh, if you read anything about previous pandemics and epidemics, in every case, the underlying theme is increased productivity. Somehow we figure out how to make ourselves more productive. In the final quarter of last year, GDP growth, as you can see on the chart, rose 3.4%, but the total hours worked increased by only 0.5%. So workers in non-farm businesses were about 2.5% more productive than they were a year ago. So I like to think about what happened in the 90s, right? In the 90s, we had very strong productivity growth as a result of the internet, et cetera, right? And I think we are in a very strong productivity growth cycle. But one of the differences, I think, is that we're in a productivity growth cycle that is supportive of businesses and technology rather than consumers. But the economy is not without its risks, right? I think Marty and I chatted just earlier that the finance industry is vulnerable. Banks are vulnerable. Real estate is vulnerable. Commercial property, threatens to blow a hole in portfolios and some balance sheets because there are hefty paper losses on not only the bond, but the loan holdings, even as we refinance, right? We also, on the consumer side, have delinquencies in credit cards and auto loans. These things are really, they soared last year and they're rising above pre-pandemic levels. People got used to spending free money and we can't do it anymore. So this is going to be a continuing trend even as unemployment goes up, which could be very problematic for consumption in this economy. So even if these problems prove manageable, right, these short-term interest rates at nearly 5.5%, higher than they have been in 20 years, are going to weigh on this economy. So in my opinion, declarations that America has achieved a soft landing might be a little premature. And I think that's consistent with some of the comments I heard before we got started this presentation. It's true that growth has been remarkable, resilient, and that inflation has softened. But just as Susan Collins said this morning, maybe I'm putting words into her mouth, but the final stretch of squeezing out inflation is going to be arduous, and prices are still rising at an annual rate of about 3%, which is only 1% higher than the Fed funds target. Okay. So with respect to growth in the economy, right? Economists, sometimes those dismal scientists, get criticized because we're such a soft science, but one of the things that seems to work for us is this thing called leading economic indicators. And what are they saying? Okay, well, what are they? They are measurable data points that help forecast future economic activity. And they're designed to signal changes in the economy 6 to 8 months before the economy knows what it's going on, right? So it's this particular graph shows the composite of the 10 leading indicators. As you can see on the right-hand side, the year-over-year change in the leading economic indicators is minus 6.3%. And you can also see that any time leading economic indicators has a reading year-over-year of minus 6.3% or greater, or have a reading of below 100, we tend to see a recession call. So currently, of the 10 leading economic indicators that constitute this index, we've got 4 that are really causing a drag. Consumer expectations, no surprise, right? You can talk about almost anything about a consumer's life, especially the higher interest rates on consumer debt, the higher interest rates on loans. And so consumers are, while they're still spending a lot of money, they're feeling the pinch. Building permits also contributing negative, and I'm sure other panelists today we're going to talk more about real estate, but building permits are down. What's interesting recently is that average weekly hours worked in manufacturing is down. So we're seeing some softening in the labor market that we haven't been seeing in a while, including average weekly initial claims for unemployment is up. So among the leading economic indicators, these are the ones that are causing the LEI to show almost maybe a recession coming up. So if you use this as your data to project whether or not the economy was fragile or robust, you might say that looks like we might be a little bit fragile. We've got rising consumer debt, elevated interest rates, and persistent inflationary pressures, which is really causing consumer confidence to be low. So personally, and if everybody has their opinion between what data points to look at, but I'm forecasting, and this is not an Avior forecast, this is my personal forecast, that we're going to see economic growth slow during this quarter and next quarter to the extent that, and to the extent that it's a soft landing, this will be good for markets as well.
So, MK, some people might argue that we've been in a series of rolling recessions in the first place.
Oh, yes. And again, what is a recession, right? It's usually what we do is we like to, the Bureau of Economic Analysis and has specific metrics they use to, I'm going to go back to my last slide here, to identify what a recession is, right? And some people might argue that. The thing about this cycle, unlike other cycles, is this conflicting message between the two fiscal and monetary policies, right? And so while consumers have been spending, and consumers, as my first slide indicates, is a significant contributor, nearly 70, always over 60% of GDP, consumer spending has been robust. But you can see on this slide here that private gross investment, right, has been much more volatile. And so there are, you could say that businesses have been in a slight rolling recessions, right? While consumers have been robust, according to the data. Thanks, Marty. And so with respect to fiscal policy, right? This graph here shows the annual federal deficit relative to GDP since 1930. We sure know how to spend money. If the dollar wasn't such a great currency, we wouldn't get away with this, right? But after narrowing to about 4% in 2022 or so, and you can see that on your slide, it's 4 or 5%. It's back to over 6%, negative 6% of GDP. And remember, our GDP, we just talked about it, has been growing, right? We've had enormous growth in GDP. So a negative 6% deficit is a lot of money. And that's a level that's typically seen only during wars and recessions. Over the last 5 years, the average deficit was 9%, a deficit of 9%, and that's 4 times bigger than an average during the Second World War. So it's nearly twice the average for other advanced economies. But it contributed to spending and demand, and that's one of the reasons we've had such robust spending. We can see that we ran a surplus in the 90s, and our economy benefited from that because we stopped spending on defense, right? And in contrast, today, I think we probably would be thinking that we're going to spend a little more on this defense spending as a result of some of the geopolitical conflicts that exist today. In addition to, this green movement. So it's difficult for me to see how we're going to rein in this deficit. But I believe that this deficit deserves more of our focus. Again, we get away with it because of our very popular dollar. But protectionist government spending policies will harm America's growth potential. And these policies are actually delaying the timing of the cyclical slowdown that should be occurring because of Fed policies. And I'm, here to say that loose fiscal policy is a much bigger contributor to the stubbornly high inflation than other factors affecting demand and supply right now. And obviously, it's the inflation rate that's causing the Fed to keep its foot on the 5.5% or so Fed funds rate.
MK, can I ask you a question? Can you repeat that sentence about protectionist policies? I don't understand what you're talking about.
Well, for example, we have spending packages that have gone through the federal government that protects clean tech and protects semiconductors. These are protectionist policies that are protecting our semiconductor industry over others. I'm not here to play one side or the other with respect to politics, but it is true that the fiscal protectionist policies on infrastructure, clean tech, and semiconductors are incentivizing private firms and state governments to spend, okay? And so, so this spending is helping not only governments, but private industries that are more or less being protected by these policies.
Got it.
Thank you. So fiscal discipline has worked in the past. It worked in the 90s. And it worked in the 90s in part because productivity was gaining in the 90s as well, and it is today, right? So with any luck, some of this productivity will help some of these the federal budget deficit. But on the other side of the policies and the fiscal spending is revenue, right? So what we're looking at is a graph that shows the differences between what the government takes in and what the government spends. And, making tax cuts permanent, for example, and giving more tax benefits to corporations will only disturb this, right? Will only keep the federal deficit high. I think one of our candidates for office is proposing a 10% universal tariff, which would bring in about 1% of GDP, but it's all going to land, these kind of tariffs land as a form of a taxation on consumers who buy goods and services. But tariffs are also going to fuel inflation. Tariffs already have fueled inflation. And so while both of our candidates right now are paying some lip service to this fiscal rectitude, simply letting the tax cuts expire would shave about a percentage point off of the annual deficit and really move our America's fiscal trajectory forward, right? But, you know, government is going to be spending most of its budget to pay interest on supporting retirees, and that's going to squeeze money from the funds that have been going to some of our semiconductors, but mostly to schools, roads, and research and more. So if we were to slow down, this situation of federal budget deficit to GDP at a large level in an economic downturn becomes more of a weight on growth, right? So this idea that if we were to have disappointing growth in the near future, these dynamics not only will worsen, but will weigh more on the growth, secondary effects. And adds to the deficit, or the federal debt, excuse me. And if you look on the left-hand side, you can see federal debt to GDP, and importantly, on the right-hand side, the federal interest payments that we can expect as a result of that and the higher interest rates. So in '92, we can see that Americans' net debt amounted to about 50% of GDP, and today it's almost 100% of GDP. This debt to GDP ratio is not expected to decline given our fiscal and monetary policies, and could likely become over 150% of GDP, like Japan, whose debt is 150 or plus percent of GDP. Yet Japan has no issue issuing bonds, right? They still are able to issue new bonds, and America is likely to have extra latitude because of the dollar's role, right, as a global currency. So I don't know really I think it was Modigliani, an economist back in the 40s and 50s, who said debt is neutral, right, if you can at least spend your way out or print your way out of it. But the expansion of our debt right now is exacerbated by our rising interest rates. So in the last 20 years, interest payments accounted for about a third of the federal deficit. In the next 2 decades, it should be 2/3. This is a heavy burden to carry, right? And it's a much graver risk than it has been in the past. But nobody seems to be sounding alarms, except me. I'm joking. But it's hard to judge when a crisis is likely to strike. Again, our dollar as a preeminent currency really allows us a lot of latitude here.
MK, can you just comment on the fact that we are printing lots of dollars, yet the dollar is keeping its pricing ability relative to other currencies? I think the yen has crashed, for example, recently.
Yeah, the yen dollar, it crashed. Look, the dollar is a preeminent currency. The Fed funds interest rate at 5.5% is supporting the relative value of the dollar. When you think about the monetary policy in the other countries that might compete, remember, currency, the dollar or any currency is not an absolute price, it's relative to other prices, relative to other currencies. So when the dollar-yen relationship changes, it's not just what's going on with the dollar, but what's going on with the Japanese yen as well. So Japan is causing interest rates to rise a little bit, but still they're basically zero. They're finally not a negative real interest rate. So relative to the yen, the dollar still has, as a currency, relative attractiveness.
Most other economies are keeping their interest rates lower. Is that right?
Yes, they don't spend like we do, Marty. No, they absolutely don't spend like we do.
My understanding is that China's interest rates are around 3.5% right now.
Yeah, if you can believe that is actually not a free float, right? But it's a contained currency, but that's about right, about 3.5%.
So what would you do to reduce the deficit, MK?
Oh, shucks. This is why nobody does it.
We're going to make you president, hypothetically. What would you do to address the issues that you've described? You said there are problems between the fiscal and the monetary. What things would you recommend so we get this situation back from 34 trillion and all the problems that we're looking at?
Tyson, that's so way above my pay grade. But
you're a PhD.
Yeah, but my pay grade, right? So somebody, I think that
answer this and your pay grade will go up.
Yes, yeah, get it right, and the pay rate go. Let the tax benefits expire. So fiscal policy, don't lower taxes on corporations. I know that's unpopular, but we have to get in more revenue and we have to spend less. This indexing for things like Social Security, means testing would be a really great way to shore up some of the policies that are costing the government most, which is Medicare and Social Security. Those trust funds are expected to be gone in, I would say, in about 15, 20 years, and we could really support them by means testing. Sorry, guys, that's why nobody's doing it. It's like taking money away from people, or taking a promise away from a group of people like us who might be able to pay more of our retirement with our own funds, and giving it to someone else is extremely unpopular. But the gap has to change, right? And certainly subsidizing industries for political gain, the kind of protectionist policies we just talked about, is, in my opinion, a waste of money. I tend to be a bit more of a globalist, less of a protectionist, a free trader. And so with those things in mind, those are a few ideas that I would implement, or at least examine.
MK, given that it's a complex world and that you can be a globalist, but at the same time you can have defense concerns, I think one thing that's globalism has shown is that the offshoring of production has been very negative on ability to defend one's country. So,
well, and again, right? That's what this group is all about. The question was what it was, but there are risks to implementing policies that would improve the deficit.
We have a question from the audience. Yeah.
Quick question. How do you benchmark the quality of deficit spending? Because if you look at countries like China, for example, and many Southeast Asian countries are also deficit spending, but they're investing in infrastructure. They're building out a lot of, I would say, foundation for kind of future growth of their economy. We don't seem to be doing that. We're spending a lot of money, but we don't see any of those big infrastructure. On the contrary, I mean, infrastructure seems to be falling apart.
So the question is, how do you benchmark deficit spending where China spends on infrastructure, we're spending on refinancing?
I'm not sure how to address the benchmarking of deficit spending, but I agree with the comments that there are economies, including India, for example, spending a tremendous amount on infrastructure, but it's kind of more of a technological infrastructure for them, not so much roads and buildings, but by investing in those things that long-term are going to cause the economy or enable the economy to be more robust. And again, it goes to my previous comment that, so for example, if the most recent fiscal spending on some of the semiconductor surplus, right? If the idea there was not just to protect, but rather to grow our economy, might be a more palatable thing for people like me, right, to accept. So I totally agree with the comment that the quality of our spending is something that we can certainly criticize right now, especially compared to other economies.
I just think I'll give one example. I think that they are canceling the California high-speed rail. Is that correct? I was reading recently that the high-speed rail that they spent tens of billions of dollars on is being canceled.
Not the line to Las Vegas. I think that.
The line to Las Vegas is going to happen, but the line from San Francisco to LA will not happen, right? So it's just also about will to make things happen. Other questions?
Yeah, just, oh, sorry.
David,
Yeah, just real quick, at what point does the percent, at what line is the percent of spending servicing the country's debt become incredibly problematic? And I'm asking because 1/3 sounds high to me. You say that we're gonna be going towards 2/3. What are countries like Argentina, Zimbabwe, Turkey, countries that have had real problems over the last 30 years, where are they and, how do we avoid getting that?
Yeah, we haven't tested that. There isn't a line or a percentage, and that's one of the reasons we can continue to do this because, for example, just look at Japan, right? If you look at Japan as a developed international economy, a large economy with good markets and whatnot, and they were running, you were asking about debt servicing, and quite honestly, I don't know what their debt servicing is, but at 150 debt to GDP, that they had the benefit of having zero interest rates and paying that debt back at a cheaper level, but still, it had to weigh on their economy, right? The more debt you have to service, the more it weighs on your growth potential. And so while I don't know what that number is, it's because we've never reached it, we've never tested it. That one of the reasons we can get away with it is because there isn't a currency out there that rivals the dollar. And if there were such a currency, we would be much more careful about how much debt we would be servicing. But we don't have to worry about that because our dollar relative to others is still very attractive.
another question?
What percentage, the percentage of Social Security and Medicare payments that are going to people that don't really need it, what canceling that would help those two benefits survive?
Well, I think that she was referring to it's back to needs testing, right?
I love the question. You've just given me a research agenda topic. That's an excellent question. I don't have the answer. But I'll have it next time we visit because I can't even estimate what that would be, but it's an important thing to know.
So again, I mean, I keep on going with presentation. There is another question here. Processes in place to continue to erode the dollar as the world reserve currency. So we talked about this in Austin that 20 years ago, the industrialized world was 2.5 greater GDP size than the global South, and now it's 1.5 times greater. So I mean, Europe has shrunk dramatically. I think Europe was the economy in 2008 was equivalent to the U.S. economy. Now it's 2/3 the size of the U.S. economy. So I'm hoping to get some perspective from you on the growth of the global South and the challenge it makes to the dollar.
Well, don't count Europe out. I mean, I'm not. Let's see. Yeah, well, let's go to the topic and not worry about the fact that we've got these other things about monetary policy. Everybody knows the thing. Just very quickly, and Marty, I'll get there. But with respect to monetary policy, obviously, we've covered most of what we really need to say here. But what I think is important for the audience is that goods inflation, has come down, but service inflation has been perniciously, stubbornly high. Okay, so this is one of the things to watch as you guys try and forecast. As the graph suggests, the FOMC doesn't see interest rates lower than the market see interest rates lower, and one of the reasons is because of service prices, and they're just, while they remain high, the FOMC is going to be a little bit particular about lowering interest rates to where their goal of 2%. So so I'll not worry too much about this slide because you wanted to get Marty to this European. idea, or that wasn't exactly your question, but I don't count Europe out. And as one of my colleagues, Steve Esch, even in a price earnings or any kind of fundamental as far as the markets go, they're looking extremely attractive. The other thing about Europe's economy, you measure it in terms of the euro and you measure it in terms of the dollar, and depending upon how you measure it, you get quite different results, right? But Europe's really close to this Ukrainian-Russian war, and that really changes their prospects and their risk levels and stuff. So they've got that going on. The other thing that they don't do is they don't, as much as we do, have these protectionist fiscal policies, but in part they're also falling behind on the technological front, right? So they need to accelerate, in my opinion, their investment in technology if they are expected to kind of keep up with the world. But this if you're buying a baguette in Europe, it really doesn't cost all that much. So this relationship between the currencies is a big part of what I think we sometimes miss when we're assessing the viability and the strength of Europe. It is true that Europe only expanded about 3% when we expanded about 8%, but we also spent a whole hell of a lot of money doing it. They don't. They just don't do that. So Europe could jack up its growth rate by borrowing money and showering subsidies on firms like we do, but they don't do that. And so the only way, without doing that, the only way they could be maybe a little more competitive is to kind of get some of their, slash their wages or reduce some of the workers. But I expect, quite honestly, that Europe's going to shine a lot more in the next year and a half than it has in the past.
In what industry?
Gosh, services, health, their
Luxury.
real estate back.
Tourism?
Luxury. They're very good at luxury goods.
Makeups, right? Watches, perfumes, consumer goods. Yep.
And then there was another question about trade embargoes that seem to be working counter to U.S. Needs. And then also there's another question about consumer debt and interest rates for this debt. The credit card debt is up.
Oh, and short, yeah, and that, as I said earlier, is a big reason why consumer confidence has, despite the fact that consumers continue to spend the free money that they got, that their confidence has been low. There were all kinds of things that happened with the consumer, especially with respect to real estate and buying second homes for income, and that buying that home on a floating rate note, and all of a sudden that trade went away or went inverse, right? There was no arbitrage there anymore, and so that constrained spending. So credit card debt is the increase in non-payment of credit card debt is a worrisome thing right now. It's increasing, and imagine that we go into a slowdown and we have some layoffs, how pernicious that will be for the consumer, having to spend 12% on credit card debt and not have a job. So that's a big worry going forward. And so I'm not sure I addressed all the questions that you asked, Marty, but generally speaking, that is one of the things that concerns me about the U.S. economy going forward.
Sure, I think credit card debt is. I think the interest rate is around 25 to 30%.
I don't have any, so shame on me for not knowing.
No, I'm just saying. I mean, that's what's reported. So,
remember graduating and having 18% on my credit card debt, and I was surprised at how difficult it was to pay off. And since then, I've not ever had any credit card debt.
Sure, and there's the student loan debt as well, right? I mean,
yeah, student loan debt as well. Just private debt is really high.
Yeah. I mean, I've heard both sides of the coin on Europe. So and what are your thoughts on Japan? Is Japan can finance their debt, even though I think that there was a 20 to 30% decline in the yen versus the dollar since January.
Yeah, so the Japanese finance their debt in yen. So the relationship between the dollar and the yen, I don't really think has too much of an impact on their ability to finance their yen, right? But they finally have positive interest rates, right? So their interest rate right now for overnight loans is 0.1%, but it's not negative anymore. And they've also scrapped their policy yield curve control, right? That capped their long bond at 1%. Just like pricing caps, these kind of interest rate caps create artificial economies that sometimes have unintended consequences. But having kept their monetary policy ultra loose for years, they've finally begun to follow the course of other economies during this inflationary period and cause their interest rates and therefore their price of their currency to finally be positive. So yeah, they have a lot of indebtedness. Their debt to GDP is closer to 250% in gross terms. After you net out some of the government financial assets, maybe about 160, but both of those measures are the highest in the developed world. So even with their low interest rates, nearly 9% of their government budget is being spent on debt interest. So maybe to answer the other question that was asked, what's that line in the interest level relative to the economy that causes the economy to slow? Well, something less than 9, right? But greater than 5. So they could
Great.
never understand the kind of
We have another question from the audience.
question.
Thank you, Marty. Can you address the demographic trend, which is, I believe that's a couple of other sessions I've been in, even with Larry Summer, that seems to be a very, very powerful trend that will, overshadow
In the United States or in the West in the industrialized West in general?
demographics will affect us. All right, if you have aging population in the same way Japan had,
Right.
they were never able to recover from it.
Yeah, yeah.
And now you've got China in the back of that, and then I think in relationship, for example, to Africa, you're going to have massive population growth. So those trends are pretty powerful.
But people don't understand Africa is the same size as Asia in terms of land mass.
Yeah, I
Right.
believe in 2050 it's viewed to surpass Europe in terms of population, and then you have and mostly younger crowd than older.
Yeah, yeah, sure.
And besides that, I think you're seeing quite a bit of migration, for example, out of Europe to the Middle East, for example. I'm seeing Dubai and UAE and Saudi Arabia.
Interesting. Yeah.
There, and
So any thoughts, MK, on the demographic crush that the West is experiencing?
No, just
And China?
just I would say that in the aging population like Japan's, that question is loaded with a lot, right? But just to kind of close out here, I think the aging population in Japan, the problem with having an aging population is at least in Japan's case, it doesn't mean that it has to be the same way in others, but in Japan, that's a lot of savings, right? That's a lot of money that's being saved and not put, and there's no opportunity to use that for productive resources, right? So for growth opportunities, for capital investment, there's a lot less appetite for that because of the economy. So while the demographics is a terribly interesting topic to get into, I think the addressing that has you need to do that along with the economy itself with respect to that. But clearly, those populations who are growing are those populations who are likely to see capital infrastructure and capital investment going forward.
Right, but I think the assumption of capitalism is that to support the leverage that people will grow into it, not shrink from it. So, right, I think the population growth is kind of assumed with a capitalist system, or at least one where a currency has a 2% growth target rate.
Well, I mean, you could get into the politics of it too. It's migration and immigration that helps aging societies, right? Ours included, but Japan doesn't allow immigrants in like Africa would allow immigrants in, and their economies are likely to benefit from that immigration growth more than someone like Japan's and maybe even ours.
Yeah, I'm not sure if I agree with that statement. Anyway, what is, so did we talk about the impact of the, lack of 4 interest rate cuts this year? On the general economic outlook?
Well, so I guess I just want to point to this graph here. I tend to be one who looks at the data more than listens to the markets when it comes to what the Fed's going to do with respect to interest rate cuts. The Fed's been really clear. Now, will the Fed get to 2%? I said a long time ago, I don't think the Fed's going to get to 2%. And they may never get to 2% in my lifetime again. They might, but that's going to require a recession, in my opinion. So I think the Fed is going to have a little bit of room, given all the data that I've been looking at, a little bit of room to have an interest rate cut or two this year. But if what I said is true and the economy softens in the next quarter and the third quarter, it's likely that that's going to set the stage for at least a couple of more interest rate cuts.
So the thought was that cuts would start in April and then rapidly progress after that. And now the talk is no longer a cut until December.
Marty, I don't listen too much to the talk because it's been wrong. And the Fed makes mistakes too. But while goods inflation has gotten to very close at a 3%, they want 2%, goods inflation has gotten there close to where the Fed needs it. Service inflation is far away from that. And we're a service economy. And so I think they're going to be very careful before they lower interest rates 4 times, right? They're going to test it. And again, the slowdown in the next quarter or 2 is going to help them do that. I don't see 4 cuts this year.
Any other comments? Any questions from the audience? Yes, Brad?
If we experience 4 interest rate cuts in a matter of 6 months, what's your take on where we'd be sitting, how the economy would be holding up at that point in time? Because I think it would be a lot of blood on the streets if we had 4 interest rate cuts in 6 months. I'm just curious your take on it.
4 interest rate cuts in 6 months. Why would it cause blood on the streets?
I think it would be that. Well, it's a question. I want her opinion. That's just my.
Is 4 interest rate cuts in 6 months good or bad?
That to happen.
I don't look, if the economy can handle 4 interest rate cuts, that would just mean we have a much softer economy. Whether that's blood on the streets or not, I don't know. But it would definitely mean that unemployment was higher and people were without jobs with high debt, right? Capital markets would love it, but I have to think about that one a little bit. I don't see it because I don't see prices getting to where the Fed needs them to be in order to have that happen.
That's why I say I don't.
I think gasoline pricing is pretty high right now, and I think that we just dodged a bullet with Iran a couple of weeks ago. So hopefully that situation will be avoided.
Marty?
Last question.
Any change in the administration in the upcoming election, is that going to affect anything, or will keeping the same affect anything?
Oh, next time if I'm invited back, and I hope to be, that we can look at that. I've crunched the numbers, and then I've recently read studies that are consistent with the research that I did many years ago. Administrations largely have no impact on the economic growth or capital markets. Now, I say that after having spent an hour with you guys talking about how fiscal policy is important, right? But to date, what we would see if we were to get Mr. Trump in office was, we would see things that are extremely inflationary, right? In terms of trade and taxes. We know that taxes are the revenue source for our deficit. So we'd see inflationary prospects there. But, you know, keep the Democrats in office and they sure know how to spend money. So the very complicated question, but I will share some of that with this group next time, because it's quite telling that administrations have very little impact on our domestic economy.